Hello and welcome to the Property Trio, the podcast for the sophisticated property buyer. All right, it's that time of year again, the episode everyone loves and we like to debate and get nervous about. And it's our predictions episode today. So welcome, Mike and Cate. I hope you've got everything ready to go with your work, decided upon your predictions for 2026? Yes? Take that as a yes?
Yep.
I actually called in sick. Cate told me to get stuffed, so I'm here. This is a good one to miss, because you could sail through into the next 12 months and go, I would have said that one would have been the top, and you guys really biffed it. But yeah, unfortunately, we're going to have to face our predictions in 12 months' time, and of course, we've got the 2025 predictions wrap-up episode that'll be coming out soon as well. And some of us did some good material. Others, it's going to sting.
Before anyone gets too excited, just to be clear for our listeners, even though this is a lot of fun, we don't have crystal balls, or it's not about tarot cards, or saying to your friends at the Barbies over Christmas and New Year's that I was listening to this podcast and they reckon prices will double by Easter. That's not what today is about. It's about looking at the data, the trends, the policy settings, the stuff that's quietly happening under the hood, and asking one simple question: where does the property market actually go to from here? So before we dive in, this episode is a bit of fun to put together, and we know our listeners enjoy it when we go out on a limb and make some bold calls. But as I was just alluding to, markets move, headlines change, predictions come and go. But what's important is to make long-term decisions and that suit your own personal economy and not get too caught up in the short-term noise. Or time the market perfectly. So today's episode is a bit of fun, and hopefully you'll get a lot out of it. But remember to think long term. So without further ado, we'll start with the first big initial question, guys. What will the market do in 2026?
Mike's going first.
Well, I heard you say, Dave, prices will double by Easter. So we've got the tagline for the show sorted. No, look, I'll be serious.
It's my prediction.
The national dwelling values, I'm saying in calendar 2026 to rise between 5 and 8%. Now, is that an acceptable range, or are you guys wanting me to get a little bit more specific?
More specific. Yeah, more specific.
I think we can have a range, but then come up with a single number.
Oh, geez. Okay. I've got a 3% range. Look, if I was going to make that a 2% range, I'd say 5 to 7. I'm going to say 6% across the country. We're about 6-7% over the last year. I think I predicted that to be a little bit lower, so it's surprised a little bit on the upside. I think there's going to be quite a bit of growth led by the mid-sized capitals. I think investor lending is a little bit of a concern, and we are reaching that point where APRA might sort of jump in again and say, look, we're considering caps on interest-only loans and those sorts of things. I also kind of expect that the economy is going to be printing quite a bit of inflation in the next little while, and we're more likely to get a cut than a rise. And I know that those things don't necessarily work in perfect concert, but I just think there's a little bit of headwinds to sort of counteract that positivity in the market. So I'm tipping 6% for next year.
Okay, good summary.
Nicely done.
Cate, what are your thoughts?
Okay, I'm going to say nationally we'll do 7%. I know that's quite specific. I think nationally we'll be a tad under what we did for 2025. And 2025 we're at 7.5%. So I'm going to say 7%. I don't think it will be a disaster year at all. I don't think the heady performance that we've seen from the big performers will be quite as strong next year. but I think Sydney and Melbourne will continue to have steady gains or modest gains. And I agree with you, Mike, that the talk around interest rate cuts will slow right down. And I think talk about increasing interest rates will just moderate buyer behaviour and investor behaviour in particular. And I think, APRA has flexed, but I'm not convinced that they'll need to step in. I think that will moderate naturally because people are very cautious when they can see that there could be an increase in the cash rate. So I think it'll continue to be a steady and positive year, not a gangbusters year, and I don't see any. I think that we can anticipate seeing gains across the board for all of the capitals, and I also think that regions will continue to either match or slightly outperform the capitals.
Okay, so you've led into a few of the other questions that coming up. So we've got a few clues about what you might be thinking in some of the other areas. So, Mike, your range and number was for predictions for the price growth.
We dumped the range. My range,
just to reiterate for our listeners.
Well, so it was 5 to 8%. But if I was pressed, 6% and the 5 to 8% range.
Okay, and Cate, yours was again for listeners
7%.
Okay, so we've got 6% and 7%. All right, okay, very good. So mark that down on your bingo cards, listeners. I think inflation will be the key this year for price growth. I think if it gets back under control, then rates may come down and prices will move up faster. But I do think governments really need to rein in spending for that to happen. And we do need to boost productivity, which has been in the doldrums for a long time. So overall, I'm concerned inflation will be harder to manage than expected. So although at the start of 25, I expected 26 prices to outperform 25 by a fair bit, I now think we'll have a similar performance to 2025. Because I just don't think inflation will be brought to heel quickly. And so we may not have any more rate reductions, and there's also actually a risk of rate hikes this year. So I do think we go into the end of the year with a fair bit of momentum. So I'm a slightly more bullish, just a tad, than both of you. My range was 7 to 10%. And if I'll pick one number, which I had, which is just the mid-range of 7 to 10%, 8.5% is where I'll pin the tail on the donkey for price growth in 2026. So let's see where we land, shall we? We're all pretty close together, 6, 7, and 8.5%. We'll know in 12 months who's the winner.
Glass half empty one on Australian property prices. There's another potential topic, subject for the show notes.
Yeah.
And interestingly, Dave, just to add a little bit of flavour, SQM with their boom and bust report tipped national price growth at 6 to 10%. So we all fit within that range.
At what?
They're at 6 to 10% nationally.
6 to 10, right? Okay, there you go. Yeah. I can't.
But probably
I must admit, I haven't read that, and slightly more optimistic. Well, they've gone for a bigger range too, haven't they?
Yeah, I know. It's cheeky. And and then of course there's the 4 different verticals. Well, if interest rates do this, and if migratory albatross start going in the other direction, it'll do this. There's a lot of little caveats and disclaimers.
Yeah, they do. Yeah. They have about 3 different versions of their predictions, don't they? If rates go up by this, if they come down, if they stay, this is our base case. Yeah. Cover all bases.
I think there's actually
unlike
4.
Us. 4 now, is there?
No, we just ride the lightning.
We put it on the line. Yeah. All right, let's move into our second prediction. Who will be the capital city top performers? And we'll start with you on this one, Cate.
I've really struggled with this one. because I think there's some headwinds facing Adelaide. And so while it's just been this amazing performer that's just gone and gone and gone, I don't think that it's going to be up there this time around. So, and I know that Perth is really shining and Darwin's had an incredible run. I'm actually going to say Brisbane. I think
Brisbane number one,
top performer. Yeah.
And then who have you got for 2 and 3?
Yeah, so I've got Perth as number 2, and number 3 I have struggled with a little bit because I guess I'm knocking Adelaide out here. I am mindful of Darwin's performance, and I don't think that we've seen everything that Darwin's got yet. So I'm going to list that as number 3. But I think that Melbourne and Sydney won't be as diminished with their growth as they've been this year. We've talked about Melbourne's recovery, but it's been a pretty modest recovery. I think that we'll see Melbourne as a close third as well. So that's where I'm sitting.
All right. So just to reiterate, your top 3 were 1, Brisbane.
Yep. 2, Perth. And 3, I'm really undecided about whether it's Darwin or Melbourne.
Okay. Very good. All right.
Is it right? Yes. If you're pressed.
Exactly. Right. If I was pressed, I'd say, or I'm going to say Melbourne just to keep things interesting.
Right. Okay. So Brisbane, Perth, Melbourne for Cate.
Brisbane, Perth, Melbourne. With
bingo cards marked. All right, Mike, who have you got?
Look, I was looking very similar to Cate until she took a left turn at Albuquerque in the end. But I've gone Perth, Brisbane, and I had Adelaide when I was first crunching these numbers, and I've since dumped it for Darwin. And I think Hobart's a smoky, but I'm happy to take that off the podium just so that you can lock me down on Brisbane, Perth, and Darwin. I think Perth is still the standout. If you look at the Cotality results, 2.4% in November still after a huge run, and I think there's still room to move in terms of affordability. I think we'll probably see a good upgrader market. Any of the investors that are selling to lock in the profits won't, I don't think, marginally increase listings. And the more frequent transaction is probably a better chance to post an increase in the median. Look, I think those mid-sized capitals are the ones that are going to do a little bit more in 2026, partly due to the lower starting point, very, very low vacancies like in Perth and Adelaide, but that Adelaide I've just sort of dropped off. And I think Sydney and Melbourne will grow, but more modestly. I think Melbourne will outperform Sydney by possibly twice as much, but I don't think we're going to see necessarily 15% growth, and I think that is still a possibility in places like Perth and Brisbane, despite them having had quite a number of years in the sun already. I just still think there's a little bit of momentum, and I think Darwin, we're probably yet to see the biggest monthly increase in the data yet for Darwin.
Yeah, okay, that's interesting. So you've gone with Perth number 1, Brisbane number 2, Darwin number 3. And
yep.
My top 3 are quite similar, but I think Darwin, just because it's got so much momentum and it hasn't been running for as long as Perth or Brisbane or Adelaide, so I'm going to have Darwin at number 1 again for 2026. And then I have Perth. I mean, it's still got so much momentum. Its metrics for affordability are still reasonable. So similar to your points, Mike, I have Perth at number 2. And I actually have Hobart, as much as you jested about me putting Hobart at number 1. I can't remember whether that was when we were on air or before we got on air, but I actually do sneak Hobart in when we're off air. Yeah. I actually do have Hobart down as number 3. And so here's a few data points on why. So number 1, it is the lowest entry point relative to its previous peak of all the capital cities. So it's still 6.9% below its previous peak as at the end of November 25. So Canberra's 2.4% below its previous peak. Melbourne's just below at 0.9. So, notionally it has the most to gain in that space. I think it's already getting a pivot from investors, which is underway now that there's been the formal approval for the new stadium and the AFL team, and then all the development and excitement and that the tourism that's going to create for Hobart. So I think that's playing a role here. A bit similar, like to the idea of Brisbane getting the Olympics, but this is actually something that's sustainable for the long term, and it's impacting a much smaller marketplace than, say, a Brisbane. Also, its rental growth is currently rising at 6.8% per annum over the last 12 months. So as at the end of November. So that's second only to Darwin, whose rates have risen by 8.6% and compared to the combined capitals of 4.5%. Also, as of November 25, according to SQM Research, its total listings are down 14.2%. Old listings are down 10.2%. So that's signalling quite a bit of demand there. I do think I thought Adelaide would falter this year, but similar to you, Cate, I think it's going to falter in 2026. Few data points to back that up. It's the only capital where annual rental growth is on an easing trajectory. I think affordability is getting stretched for the locals. Old listings were the highest percentage above last year of all the capital cities in November. And it also had the worst performance in distressed listings from November to November. So I think there are a few little signals that Adelaide might be finishing its run. That was probably just 12 months too early last year on that. In terms of Melbourne and Sydney, I really just feel like if there was a index that removed all property prices above 1.5 million, I think Melbourne and Sydney would be performing reasonably similarly to most other capital cities. But I just think because the depth, the volume of properties in those two capital cities above that price point, 1.5, 2 million, it's just not as competitive in that marketplace. We know investor numbers, which I'll share later on in the episode, have grown significantly this year. And they're mostly competing probably in the $400,000 to $1.2 million space. So I think that actually impacts the indexes for Melbourne and Sydney. But it'd be interesting. I don't know. I don't have anything that I can go to formally back that up. I mean, Cotality's index, values a modelled level of prices, not a median. So that's going to have an impact. That's who we rely on for our index. It allows for property characteristics, land size, location, number of bedrooms, living rooms. So the intent is it's not affected by the sales mix of the month. It just doesn't rely on recent sales. So it imputes a current market value of every dwelling in their database. So I just wonder if this has an effect on those two markets, but interested in both your thoughts before we move on to our next prediction.
Yeah, it's a good point. I think especially with Sydney, with the median being so high, I feel like it's harder for it to print big numbers compared to a place like Perth, Hobart or Darwin, especially Perth when we think back to when its median price was, I think, maybe second or third worst or cheapest, I should say. And there's just so much room to move with transactions over that point. But yeah, with Sydney, it's a pretty big median, and there's just not as much space for it to be pumping like a 20% in a year. I think those days aren't going to happen anytime soon.
Yeah, and I think looking at the differences in these markets, certainly from a price point point of view is a smart way to look at it. And we've talked about this so many times on the show. When you energise one segment of the market, like for example first home buyers, you can see medians drop because you're generating a lot of sales at a particular price point. And we've got to be mindful of that with these, larger median price areas, and particularly the housing and the unit mix, and which segment of the market is sitting firm on property and not selling versus, which segments are buying. And we've also got new builds. We've got a lot of government intervention at a state government level for affordable and new housing. And of course, when we use the word affordable, it is exactly what that is. It's lower price point properties. So I think your point's really good, Dave. If we've got a market like Sydney and all of a sudden there's a lot of higher density development taking place due to, the housing crisis, and you're generating sales at lower price points in a disproportionate manner, well, then you will find that your medians move, and way more sensitised or sensitive market movement.
Yeah, so I think it'd be interesting to be able to look at that. I mean, even with Sydney's median being higher than Melbourne's population is very similar to Sydney's. So it does have that volume or depth of property values at the higher end, not that far removed from Sydney's, obviously, but on average, slightly lower prices. So, yeah, I think it makes it harder to move the dials on those two, particularly with the space where investors and the first home buyer boost are operating in each of the capital cities. So let's move on to regional locations. What are your top three predictions, please, Mike?
I've really struggled with this, and look, I'm hesitant to sort of give like a city rather than like a potential area, but I mean, I'm going to have to, I suppose. Look, I think regional Queensland, followed by regional Western Australia, followed by regional Victoria, are probably my 1, 2, and 3. That'll hopefully give me some ability to salvage these predictions when we look at it in 12 months. But Queensland, look, I think it might be something of a bit of a lifestyle location, something like Mackay or an Airlie Beach, or potentially a Toowoomba corridor. Like, just because it would be an absolute Hail Mary, I'd like to throw Airlie Beach out there as a possibility. Whether that's going to be 1, 2, or 3, let me just actually think this out while I'm saying it. I think regional Western Australia, it's going to be some of those areas that are sort of resource exposed and the Perth commuter belt. So I would have loved to have said a place like Busselton. That sort of fits that category, but it's had a stonker of a year. So I think we probably might need to go a little bit further afield. And I'm not super familiar with that part of the world. For Victoria, I think it's going to be a place like Ballarat, and that could really potentially be the top performing region, just with the anecdotal evidence I hear of so many active investors in that particular part of the world. And I think it's often like a Melburnian satellite city that seems to move in lockstep, and we're seeing a lot of heat. In Melbourne, we're not necessarily seeing it in the numbers, but those regions do tend to follow, a bit like the sort of Sydney Wollongong or Newcastle relationship. Just make sure I've got that right, Cate. Bendigo's the one that's further away than Ballarat, right? I always get them mixed up. Yeah, so Ballarat would be my pick. So, look, I might put Ballarat into second place. I'll put Airlie Beach. It'll be something of one of those sort of desirable lifestyle type markets that has a little bit of diversification away from tourism. And then I'll probably go to somewhere regional Western Australia. And look, I don't have a really great answer for that. There was a lot of press about places like Mandurah. That I remember that being on a current affair, with people like paying 80% more than what the valuations came in, and then it's gone through the roof. I still think somewhere like that could be quite attractive because it's commutable distance. It doesn't necessarily have that resource exposure. But yeah, look, are you going to give me a get out of jail free without an actual city?
Well, you just meant to state the state region.
You've gone into
you've actually narrowed
detail,
in. Yeah,
like Mortlock.
yeah. I'm not going into that level
if you're
of
happy,
detail.
I'm happy.
Yeah. I'm going to...
Yeah.
I'm close to you, Mike, and I don't want to sound boring. The ones that I'd noted, number one region is regional Queensland, followed by regional WA, followed by regional New South Wales. And I've got a little bit of a different rationale for how I got there. I think Queensland Brisbane's seen some really strong gains. We also know the Sunny Coast and the Gold Coast have had enormous outperformance as well. And what this does is it obviously displaces people from an affordability point of view who can't keep up with that, whether it's rents or whether they're just feeling like, maybe it's time to cash in and move because they're retirees, or if the concept of heightened interest rates bothers them, they might want to downscale. So I think that we're going to see a lot of movement into the Queensland regions from an overheated larger market point of view, and also retirees cashing in. I think WA, the reason I've kept that on the list is it just outperformed so strongly last year when we look at the league ladder. And Perth's not running out of steam, and regional WA has been in lockstep with Perth. So that's my rationale there. Now, New South Wales, we're seeing a lot. I'm personally in our business, we're getting a lot of Sydney-siders moving to Melbourne, and they're citing affordability. And it tends to be younger people, and they're quite mobile. They can come down here. It's easy to fly home or drive home if they want to, and they can usually carry their jobs down here or get work down here. But I think that we'll see a lot of people move into the regions in New South Wales in response to the cost of living in Sydney, and a lot of people are loath to leave their state. Also, we have a lot of retirees coming on stream, and there are some really gorgeous and affordable coastal regions in southern New South Wales in particular, and I think that we'll see an increase in the rate of people calling the New South Wales coast home.
Good insights, Cate. I think they're all make sense, and there's a lot of logic behind each of them. My predictions, I'll keep it reasonably simple. That, as a general rule, the top performing capital cities match the top performing regional locations for those states, and that's tended to be the case in recent years. So I'll pick WA regional as number one off the back of Perth's continued outperformance. I won't go into any more detail than that. I think Tassie number two, for the similar reasons that I discussed around why I had Hobart as the third highest performing capital city. And then I'll actually throw Queensland region in as number three because of the continued migration towards places like you mentioned, Cate, whether it's the Gold Coast or the Sunshine Coast or Airlie Beach, where we spent 6 days on our caravanning trip. And I mean, the change in the feel and vibe of Airlie Beach, having been there last time 20 years ago to now, was pretty amazing. It almost had sort of almost a Noosa sort of style vibe about it. Not quite at the levels of Noosa, but it's certainly gone through a huge...
That's what I'm banking on.
Yeah. So there's still value. There's value. There's lots to do up there. It's certainly gone through a transformation, and there's a lot of good-looking people migrating up there, which you also see around, say, Burleigh Heads on the Goldie. It's definitely got one. It's one of those kinds of locations that, for example, Noosa's gone through over a few decades now. So they are my predictions. So number four, what do we expect to happen with investor numbers? Are we going to see more investors get into the marketplace as a percentage of the overall property buyers in 2026, as we've started to certainly see happen, particularly in this back half of this 2025? Or is that going to start to plateau? And any thoughts on why it might move one way or another, guys? Start with you, Mike. I'll start with you, Cate.
I think investor numbers will slightly decrease. I don't think it's going to drop off a cliff at all, but I don't think we'll continue with this juggernaut that we've got at the moment. I know that APRA's already flagged that they're pretty concerned. A couple of reasons for that. I think talk of the cash rate moving will put a few people off or slow down their plans. I mean, if we think about it, we've had a pretty big year of investors returning to the market this year because we've had talk all year about interest rates moving down, and everyone's been, quite bullish about the fact that 2026 would see interest rate cuts until very, very recently, with inflation getting in the headlines again. Now, inflation is sticky, it's problematic, and it's harder to navigate than what they've assumed. And Dave, you mentioned that earlier. I think I believe that will be economically our biggest challenge next year. And so even if we don't have interest rate movement, I think that the talk or the threat of that happening will just subdue a bit of investor activity. And I also think share market volatility, which is something I cited last year as a reason for investors to jump into property this year. I think that people are getting their head around where things are globally, and certainly, some of the surprises that we've had out of the US administration. We're all kind of getting used to it. So unless we have something go really pear-shaped with the stock market, I don't think that we'll see investors continue to rise in number into 2026.
Okay. Yep, that makes some sense.
I would say, hard to argue with that. I've sort of
but you will
pinned investors to be holding. I've got investors holding to about 38 to 42% of new housing loans. So that's, I suppose that's it's a holding point, or maybe a very, very mild contraction, but there or thereabouts. I do expect investor lending to rise 10 or 15% in value terms through 2026. So the percentage of investors to basically hold maybe drop by 1%, because I think we're at about 41% in the September quarter. We saw a 17 to 18%. Yeah, right. So we saw 17 to 18% growth in value terms for the September quarter. So already, we're pretty tight. We're hitting up against that ceiling where APRA sort of, in case of emergency, smash this glass and do something drastic. Yeah. But yeah, look, I think that we can't expect it to rise much more. I mean, we're close to sort of the record highs, and I think interest rates will make people a little bit more cautious. But I do expect the values of lending to rise by 10 or 15%.
Okay. Yeah, look, that's interesting. I probably should have even started by just quoting some of those data points, because I have them here, but I'll share them with our listeners now. So at the end of the December quarter of 2024, investor loans as a percentage of new purchases was 37%. And then, as you just quoted, Mike, at the end of the September quarter, they were at 40.6% or 41%. So again, just to remind our listeners, when it hit 46.4% in 2015, that's when APRA stepped in and cracked down on interest-only loans. They cracked down on the percentage of investment loans lenders could write. So we're creeping towards that number. As you touched on, Mike, investor lending for new purchases over the last 12 months grew by 18.7%, whereas owner-occupieds only grew by 9.8%. So there's been that disparity. And just another number in terms of the number, like how many individual investor loans are written, it's just hit the highest number on record in September, at the end of the September quarter for 2025. So that's a number that's been being tracked since 2019. So look, in short, I think it'll continue to grow. So we're at that 40% mark. I think it'll continue to creep up. Now, where that gets to, I don't think I can really put a number on it, but I hope it doesn't get to 45% and we see extra, macro prudential lending crackdowns by APRA. But I do think it will continue to grow. I just think there's that momentum there. But look, if inflation stays sticky, like I pretty much expect it to, and particularly if we have one or more rate rises, that'll pull it back. So I think either APRA intervention or sticky inflation or rate rises will stop it from hitting the previous peaks. So I'll say, 43%, somewhere around there it might get up to.
Nice. That's
All right.
Conveniently outside of my 38 to 42% range. So good on you, Dave, for being slightly contrarian.
Yeah, well, we all need to be different. It'd be very boring if we made the same predictions. Okay, so prediction number 5. Do we think there'll be any government intervention into the property market, which we've sort of danced around a bit with talking about APRA?
Yep.
Go for it, Cate.
Do you want to go first?
Go for it.
I've got 3 top things to suggest. The first one, I think that we'll see tougher regulation across rental properties in other states. Victoria's led the charge on onerous rental reforms, and I think we'll see other states move in step with that. Not all of them, but I think we can anticipate that. The next one, I think that ASIC is going to tighten up really hard on SMSF property, and in particular advice and advisors and some of the rogue stuff that's happening out there. We're seeing and hearing stories on a semi-regular basis of people that have fallen prey to spookers or made bad decisions, and I think that the focus from ASIC has got sharper. It's been in the news more, and I think that we'll see tighter and tougher regulation, and that might filter through into what the banks are lending and how many lenders are active in that space. You'd be able to comment more on that, Dave, than me. The third one that I'm circling is actually just for the Victorian market. So I'm sorry, listeners, I'm trying not to be too Victorian-centric, but it's in my veins. The reason I say that, though, is we've got a federal election in November 2026, and I think our opposition are going to throw everything, including the kitchen sink, at first home buyers, and they want to look like they're taking charge of solving the housing affordability crisis out there. And I naturally think that if some really exciting things are put on the table from one side, we'll probably see it from the other. So I'm expecting there might be some additional stamp duty offerings or boosts or something like that, but I think that the first home buyer market and also the vulnerable portion of the market, it might be lower income earners or single parents or what have you, I think that they'll get stimulated.
Okay. What about you, Mike?
I think I agree that with Cate that the biggest risk of meaningful intervention is either going to be state tinkering or APRA. I think it's very, very likely that the states will play around with housing. They've done it time and time again to various degrees of success, mostly quite unsuccessful. But we could definitely see quite a vocal electorate demanding, reforms around rentals in concert with housing affordability. I think it's a dangerous game given that where we're at with vacancy rates, but I expect the states to be doing something a little bit fruity. In terms of APRA, that's the biggest risk outside of the state tinkering and definitely from a federal level. In November 2025, the system risk outlook, they flagged the higher risk lending is picking up and investor credit growth is the fastest in a decade. I think that's the exact sort of language that precedes targeted speed limits on high debt to income loans, which obviously they've already done, but also potentially the interest only stuff. So if you are right and investor lending grows, I think it hopefully will moderate. But if we're talking 42, 43, 44%, I would expect them to be looking very closely at the banks and their interest-only components of their books. And that is a real big risk. I think the other one is probably rolls into the next one, but I expect that there's going to be some intervention on the supply side. And that, I think, will come from one unlikely place and one obvious place. The obvious place is construction. We're 1 million miles behind the 1.2 million homes in 5 years. Like we're into the second year, and we're about to be in our third year, I think it is, next financial year. And we're about 30% behind. So I would expect in the budget we see more for apprenticeships. We see cash handouts, more incentives. We've got depreciation changes for build to rent, those sorts of things. I think they're going to have to do that. And as a sad potential knee-jerk reaction of the Bondi situation, I think we will probably see a further significant cut in immigration, because I expect that to be a bit of a hot topic for a variety of good and bad reasons, but that will feed its way into supply as well. I think we will probably see a rethink. We've got Barnaby Joyce over to One Nation. One Nation have just announced some policies that have increased their implied vote by the largest amount since they came onto the scene, and those are in and around immigration. So, yeah, look, that's a political hot potato, and I don't think we need to go into that too much, but I think that we will see some supply dynamics changing.
All right. So, yeah, there's a lot to sort of digest there, Mike. So thanks for those insights. Look, I'll be reasonably quick. I think if inflation continues to be harder to suppress, or we have a rate rise, as I've already said, that APRA, I think they'll be tempted to do something, but hopefully they won't need to or choose to, despite investor numbers growing. But I think that might start to plateau in the back end of the year. And look, as I've been saying the last couple of years, governments are continuing to attempt to intervene to make it easier for developers. And I'll share some of the ways they've done that in some of our next predictions. All right, guys. Well, we've covered a lot of ground today with our predictions, but we'll have to leave it there because we've run out of time. So we've still got plenty more predictions to come. So stay tuned for part 2 coming up next week, where we'll cover what we expect to happen with new builds into 2026, where we expect interest rates to go, what we think will happen with vacancy rates and rising rents, where we see sales volumes and listings heading, some of the risks which could impact the market, and what we expect to occur with inflation. So until then, have a great week, and we'll see you with part 2 of our predictions for 2026.